Hello and welcome to an introduction to technical analysis, module 1. My name is Jonathan Rom, and in this module we'll be covering what is technical analysis, the differences between technical analysis and fundamental analysis, the advantages of technical analysis, the core principles on which technical analysis is built upon, and of course, lastly, the technician's tools. So let's get started. So what is technical analysis? Technical analysis can be defined by the study of price action, primarily through the use of charts for the purpose of forecasting a future price trend. And one should add in there, in order for me to participate in that trend. I do not use technical analysis to predict where markets are going. Rather, we need to understand where the market is now and how we can best take advantage of the prevailing trend. Now, there are many differences between technical analysis and fundamental analysis, but I'm just going to stick to the real major difference. Firstly, technical analysis is the study of price action. This is no secret to anyone. The prices of instruments or financial instruments, stocks, equities, currencies, commodities, they printed in the daily papers on a daily basis. And everyone would know where the rand dollar price is, or where the price of gold is, or where the price of MTN shares are. So there is no secret. Fundamental analysis studies the factors affecting the supply and demand of that particular instrument. Now, I know that this is a very generic overview on what technical analysis is, but in order to put this into perspective, there are many factors that affect the supply of an instrument and the demand of an instrument, and there are some factors that you may not even know about. So there are certain secrets, so to speak, as far as fundamental analysis is concerned. And as a technician, we would like to study what is fact rather than what is the rumor. Now, the major difference between technical analysis and fundamental analysis is, of course, this difference right here. Technical analysis studies the effect of a market move, while fundamental analysis studies the cause of a market move. Now, to put this into perspective, if you buy a share at 10 Rand and the share goes up to 20 Rand, you're not going to sit at 20 Rand and start figuring out what the reasons were that the share price moved up 100%, up 10 Rand, in other words. You're going to be happy that you made your profit and you're going to be looking to sell. Technical analysis does just that. We study the effect of a market move and how we can position ourselves accordingly. You've heard of the old Wall Street adage of buy on the rumor and sell on the fact. Well, that is exactly this difference. Now, it all culminates in this difference because the difference between technicals and fundamentals is the timing of your market entry or your market exit. Now, in order to understand technical analysis, one really needs to understand the very basic principles of what technical analysis is built upon. Now, it is something that we assume to be in place, but nevertheless, we cannot disregard these facts. Number one core principle that technical analysis is built upon is that markets discount absolutely every piece of information, known and unknown, in the marketplace. If you think that you've got a piece of information that the market does not know about, you need to think again, because the market is very well aware of what that information is, and it is probably already priced in to the action of that market. So what we are saying over here is that when public companies dish out their results or publish their results in the daily papers, the market is not concerned about those results. They are concerned about the results 6 months from that time on. So we can actually even say that the core function of the market is to discount the future, and then hence the reason why the market discounts all information that is known. The second core principle, of course, is that trends persist. Now, in order to break this down into very basic ideas, think of your school days, back when you studied Newton's first law of motion. And it stated that once a trolley has been found to be moving in a certain direction, that trolley is going to continue moving in the same direction until there's an opposing force that is put onto that trolley in order for it to stop its momentum. This is exactly the same as technical analysis. Now, I'm not saying that we can pick market bottoms and market tops, but what we do need to understand is that the trend can still continue rising at a decelerating pace. So the idea about the analogy with Newton's first law of motion is that we're not really interested in where the trolley starts its journey and where it finishes its journey, but rather the probability of that trolley continuing its journey. And that can be measured by the velocity of that trolley. So once that trolley starts to slow down, then we can understand that at some point in the near future, that trolley or that trend is going to stop and reverse itself. The last core principle of technical analysis is that history repeats itself. Now, why does history repeat itself? The fact is that technical analysis or financial markets are made up of not of the CPI index and on where the rand is and on what this governor said or on what that governor said, but rather on what the actions of people are. Now, people, we know, behave in a certain way when put under a certain amount of pressure or stress. They'll behave in a certain way and they become predictable. Now, it is going back to psychology in class, in psychology at university. When people act together as a group, they conform to that group and they confine themselves to that environment and they start moving with each other, creating this herd instinct. And this is the reason why history repeats itself. Markets repeat themselves because ideally market is made up between buyer and seller, which are individuals. So these are the very important key principles that one needs to assume in place in order to validate technical analysis. Now, there are a couple of advantages that technical analysis may have over fundamental analysis. And please don't get me wrong. I am not for one bit thinking that fundamental analysis does not work. These two approaches, fundamentals and technicals, actually complement one another. The only difference, of course, is the timing of your market entry and the market exit, as previously shown in the previous slide. So let's talk about the major advantages that technical analysis will have over the fundamental analysis counterpart. First of all, it's the adaptability to any trading medium. Now, that means that no matter what you are trading, whether it is currencies or equities or commodities, it doesn't make a difference. If there is a price, we are able to chart it and be able to participate in those trends. Another great advantage that technical analysis has is that the adaptability to different time horizons. Now, this is very specific to an individual. Now, you may have a day job, you may be an accountant or a doctor or a lawyer, that you have to go to work from 8 o'clock in the morning to 6 o'clock in the evening, and you don't have the access to the financial markets. Now, that's not a problem because we can cut our charts into daily charts. So we only are looking to analyze the end of day prices. We don't have to understand what is going on during the course of that day. So depending on your time availability that you can spend on the markets, you can cut up your time horizon accordingly. You can go from very ultra short-term trading to very long-term trading. When we talk about short-term trading, you can go from 10 minutes, half an hour, minute by minute, daily, weekly, or monthly trading. It really is about how it suits you as an individual. Another great advantage is, of course, that you can follow as many markets as you want. Now, one must not underestimate the importance of this advantage. If I had to ask you to understand or to analyze 5 companies in 5 different sectors on the Johannesburg Stock Exchange and provide you with all the information that you want, all their company balance sheets, income statements, directors' dealings, cash flows, etc., it's going to take you some time to come up with a strategy of those 5 companies. This is not so true when it comes to technical analysis. And the reason for that is that we are able to see it as a picture, as a holistic picture. Now, every market, remember, is interrelated. So what happens on the currency market will have a knock-on effect on the equity market, which will have an effect on the bond market, which will have an effect on the commodity market. So one mustn't trade or one mustn't invest in isolation or in a vacuum. One needs to understand what is happening to the overall market or to the overall markets, as mentioned, the bonds, the currencies, the equities, and of course the commodities, because everything is interrelated, and it is so much easier to have a look at a picture on which ones are going up and which ones are coming down. Another great advantage, and probably my favorite advantage, is of course the bird's eye view of the forest. Now, that's an analogy utilized to define the overall long-term trend of that market. It's very easy when you are above a particular forest, for instance, understanding and looking at which road leads you out of that forest. You can get very caught up in the intraday movements of a market and only position yourselves according to that intraday movement and without realizing what is actually happening on the bigger picture. So it's very important one looks at analyzing a market from a top-down approach, get the bigger picture, get the medium-term picture, and then ultimately the shorter-term picture. And of course, this can be done by charts. The last item that I would like to share with you today is obviously the technician's tools. Now, a lot of you out there have read about technical analysis and have even probably tried your hand at technical analysis with different types of charts. Now, there are four major types of charts that one can utilize. One can utilize a line chart, one can utilize a candlestick chart, one can utilize point and figure charts, and of course, lastly, one can utilize a bar chart. Now, it must be noted now that the most widely used form of chart is the bar chart because it gives you a lot of information and it is easy to understand and to digest. So let's look at what goes into a bar chart. Remember, each bar between the high and the low price represents one time frame. So whether you are looking at a daily chart or a weekly chart or a 5-minute chart, each bar will represent that time frame. There are three very important prices to a bar chart. That is the high price, the low price, the opening price, and the four important closes. The fourth important price is, of course, the closing price. Now, to put this into perspective, which do you think is the most important price of that particular bar? Yes, you're 100% right. It is the closing price. The reason why the closing price is so important is because that's where the buyers and the sellers have settled for that particular period of time, that 30-minute period or that hourly period. And it's that closing price that will give us an indication of a future price movement. So if you have a look at this hypothetical bar chart that you are seeing on the screen at the moment, you'll see that the closing price closed near the high price of that particular day. Now, to put this into English and to put this into very understandable analogy, is that the buyers have got the upper hand. They are the stronger or the dominant part of this particular war between the buyer and the seller. Now, we can go into the next day already with a higher probability that the buyers are going to take up from where they left off from. So it's very important that you're consistent in the chart that you choose and you also understand exactly what that chart is providing you. What type of information is that chart providing you? And as long as you can have that as a tool, technical analysis from here on in will become a lot easier to understand and, of course, to practically use in the financial markets. The idea now is the closing price alleviates a lot of the emotion of, did I get it at the right price? Am I going to be whipsawed in and out of that market? Are my stops going to be hit? Are they not going to be hit? Trading and positioning yourself based on that closing price will alleviate a lot of the unnecessary stresses that you will find when you trade on the financial markets. Thank you very much for listening to Module 1. We look forward to seeing you in the future.